Welcome to the deep dive. All right, let's unpack this. Imagine finding a really powerful way to not just invest, but to potentially defer and maybe even significantly cut your capital gains taxes. Sounds pretty compelling, right?
Mhm.
Today, we're peeling back the layers on one of the more intriguing tools out there in the financial world, qualified opportunity funds, and specifically that gateway, the often kind of misunderstood IRS Form 8996.
Yeah, it's truly fascinating when you look at the intent behind this whole thing. The Tax Cuts and Jobs Act, through sections 1400Z1 and 1400Z2, it wasn't just creating some random new tax break. It was really meticulously designed. The idea was to channel investment, actual dollars, into communities that, frankly, needed it most.
Right.
So Form 8996, it isn't just some compliance document you tick off. No, it's the annual certification that lets these funds actually claim, and just as importantly, maintain those very specific, pretty powerful tax advantages for their investors. It's really, you could say it's the operational heartbeat of the entire Qualified Opportunity Zone program.
Okay, the heartbeat. I like that. And our mission today, for you listening, is to give you a shortcut. A real shortcut to truly understanding this, let's face it, specialized corner of tax law. We're going to try and demystify the complex world of these qualified opportunity funds, explain the core purpose of Form 18996, not just, how to fill it out line by line, but why certain information is even required, and most importantly, highlight the crucial elements, the levers really, that enable that capital gain deferral and the investment into these designated qualified opportunity zones or QOZs. The whole focus here is understanding the underlying structure, right? And the strategic bits that allow these significant tax advantages to actually happen. It's designed for you, our curious listener who wants to be genuinely well-informed, but maybe without getting totally bogged down in, overly technical stuff. So let's start right at the beginning. At its heart, what's this legislation truly aiming to achieve? Why does it exist?
Fundamentally, it's about revitalization. It's about trying to breathe new life into specific, often underserved areas across the country. The government very carefully identifies certain census tracts, and they officially designate them as Qualified Opportunity Zones, QOZs. You can sort of think of them as like investment magnets specifically for community development.
Yeah, magnets.
Yeah. And the main incentive, the hook for channeling investment into these specific zones, comes through a very particular type of investment vehicle. It's known as a Qualified Opportunity Fund, QOF.
So it's a really targeted approach then, targeted at community development, essentially saying, look, invest here in these specific spots and you get these specific tax benefits. How precisely are these QOZs defined and what exactly is a QOF?
Great question. A Qualified Opportunity Zone, QOZ,
Yeah.
it's a designated census tract. The IRS actually provides comprehensive, quite precise lists of these zones. You can find them in official notices, like Notice 2018-48 and Notice 2019-42. So these aren't just broad areas on a map. They are geographically very specific to make sure the capital is directed exactly where it's intended.
Gotcha.
Now, a Qualified Opportunity Fund, QOF, that's the investment vehicle itself. It can be set up as either a corporation or a partnership, but its sole, explicit purpose must be to invest in what we call QOZ property.
Yeah.
And this is important. A QOF cannot just invest in another QOF. No, it has to invest directly into the underlying assets or the businesses within the zone.
Ah, okay. Direct investment.
Right. And to qualify as a QOF, this investment vehicle, it has to be organized under the laws of one of the 50 states or maybe a federally recognized Indian tribe, the District of Columbia, or a U.S. territory. And, for those U.S. territories, places like American Samoa, Guam, the Commonwealth of the Northern Mariana Islands, Puerto Rico, the U.S. Virgin Islands, there's actually an added layer of specificity. The QOF there must invest in QOZ property that directly relates to a trade or business operating within that specific territory where the QOF itself is organized. This really makes sure the capital genuinely benefits the local economy there, not just kind of flows through it.
That makes perfect sense. Yeah, you want the funds actually generating local economic activity. And the absolute cornerstone of this whole tax benefit structure, the core rule that holds everything up, is that a QOF must hold at least 90%. 90% of its total assets in QOZ property.
That sounds like a constant tightrope walk for the fund managers. Is it like a one-time check or is it continuous? You really hit on the crucial point there. It's absolutely continuous. That 90% investment standard isn't just, a checkbox you tick once when you start the fund. No way. It's measured at two specific points during the year to ensure ongoing compliance. This is where, like I said, the rubber truly meets the road for the tax savings. Because if a QOF misses this benchmark, even once, it risks penalties. And those penalties directly erode the very tax benefits the investors are counting on.
Wow. So it's not enough just to start strong. You absolutely have to maintain that percentage throughout the entire year. When exactly are these measurements taken? What are the key dates?
Okay, so the 90% investment standard, it's determined by the average, right? The average of the percentage of QOZ property held in the QOF. And it's measured specifically on 2 dates. First, the last day of the first 6-month period of the QOF's tax year. And second, the last day of the QOF's tax year itself.
Okay, 6 months in year end.
Exactly. And if the QOF fails to meet this standard on average across those 2 dates, well, it could be subject to penalties. And that directly impacts the return for investors who are, relying on those capital gains deferrals. Now, when we talk about total assets for this really critical calculation, it's actually a pretty broad definition. It includes basically everything from cash and investments to like furniture, fixtures, equipment, receivables, intangibles, any other items of value, whether the fund owns them or leases them.
So pretty much everything the fund holds.
Pretty much. However, and this is where some strategic flexibility comes in, QOF can choose to exclude certain items from its total assets for the specific calculation. Specifically, inventory property could be excluded. And importantly, certain property that the corporation or partnership receives solely in exchange for stock or partnership interest in the QOF that can also be optionally excluded.
Ah,
And when an item is excluded, it's not counted in either the numerator, the QOZ property part, or the denominator, the total assets part of that 90% calculation, which can significantly help the QOF maintain compliance, especially when it's managing big chunks of incoming capital.
that's a really key insight right there. I mean, it sounds like a technical detail maybe, but this ability to exclude certain assets, that could be a real game changer for fund managers trying to stay above that 90% line. How does this flexibility actually translate into, tangible tax saving mechanisms or maybe tax preserving
Oh,
mechanisms?
it's a huge deal.
Yeah.
It's absolutely by design. Let's look at two critical flexibility points that directly translate into, let's call them, tax benefit preserving mechanisms.
Right.
The first one is for cash, not immediately invested. Okay, imagine you're a QOF manager, right?
Mhm.
An investor just dropped a large sum of cash into the fund.
Right.
Now you have to find the right QOZ property to invest that cash in, and that takes time. Good deals don't just appear overnight. So without a specific rule here, that uninvested cash sitting in the bank account would dilute your QOZ property percentage. It could potentially cause you to fail the 90% test, trigger penalties, and totally undermine the very tax benefits you're trying to secure for your investors. That would be bad.
Yeah, really bad.
But there's a vital safe harbor. You can exclude this cash from the 90% investment standard calculation if it meets some specific requirements. First, the cash must have been received in exchange for stock or a partnership interest in the QOF. Second, the contribution must have occurred not more than 6 months before the test date you're trying to exclude it from. And third, crucially, between the 5th business day after the contribution and that semi-annual test date, the amount must have been held continuously in cash, cash equivalents, or debt instruments with a term of 18 months or less, so short-term stuff. This safe harbor essentially gives the QOF a pretty generous 6-month window to strategically deploy that capital without being penalized just for holding temporary uninvested funds. This is a massive flexibility. It preserves the fund's compliance and, critically, the investor's tax deferral benefits.
So it gives you that breathing room you need to find the right investment, not just any investment, without the fear of immediate noncompliance. That seems essential, especially for larger, more deliberate development projects. What's the second mechanism you mentioned that offers this kind of flexibility?
The second mechanism, it's related to QOF reinvestment in QOZ property. Look, QOF isn't just a static holding company, right? It engages in active operations. It's managing assets. This means it might receive proceeds, maybe from a return of capital, or maybe from the sale or disposition of some of its QOZ property. It sells a building, for instance.
Right, normal business activity.
Exactly. And again, if those proceeds just sit there as cash, they could potentially throw off that delicate 90% balance. So the rule here provides similar flexibility. If the QOF reinvests those proceeds into new QOZ property within 12 months, a full year of the distribution, sale, or disposition, then those proceeds are treated as QOZ property for the purposes of the 90% investment standard during that 12-month period.
Ah, okay, so it buys them time to redeploy.
It buys them time. The condition, though, is similar to the first safe harbor. Until they're reinvested, these proceeds must be continuously held in cash, cash equivalents, or those short-term debt instruments, 18 months or less. This provision is absolutely crucial. It helps maintain the QOF's qualified status and, by extension, those tax benefits for investors, even when the fund experiences, normal liquidity events. It allows a fund to successfully exit an existing QOZ investment, maybe a project that's matured, and then reinvest those proceeds into another, perhaps newer QOZ property without jeopardizing its 90% compliance status.
Right.
I mean, without this, a successful sale could ironically lead to a fund's disqualification, which would be absurd. So it's really about enabling dynamic portfolio management within the QOZ framework while consistently holding on to those valuable tax advantages.
Oh, I see. Yeah, these aren't just minor footnotes in the regulations then. They're really deliberate design choices that allow QOFs to operate effectively, manage their cash flow properly, and ensure they meet the strict criteria for tax benefits, even with normal business operations and these reinvestment cycles happening. It really changes the calculus, I imagine, for how a fund can manage its assets over the long term. But okay, all this talk of the 90% rule, cash management, reinvestment, it brings us right back to the next logical question. If 90% of the assets need to be in QOZ property, what exactly is that? How do you define QOZ property?
Excellent question. And getting this right is fundamental. QOZ property basically falls into three main categories. First, we have QOZ stock. This refers to any stock of a domestic corporation that a QOF acquires after December 31st, 2017. So, post TCJA directly from the corporation, or maybe through an underwriter, but importantly, solely in exchange for cash.
Cash only.
Cash only. And the critical part here is that this corporation must be a QOZ business when the QOF acquires the interest. Or, if it's a brand new corporation just being formed, it must be organized with the explicit purpose of becoming a QOZ business. Furthermore, and this is crucial for the ongoing compliance that corporation has to qualify as a QOZ business, for at least 90% of the time, the QOF actually holds the stock.
Wow, 90% of the holding period, too.
Yes, and for corporations organized in a U.S. territory, they only count as domestic corporations for this purpose if they actually conduct their QOZ business within that specific U.S. territory where they're organized, again, keeping it local.
Okay, so QOZ stock is one category. What about other types of interests a QOF might hold?
The second category is very similar, a QOZ partnership interest. Think of it like the partnership version of QOZ stock. It means any capital or profits interest in a domestic partnership that a QOF acquires from the partnership after 2017, again, solely in exchange for cash.
Same rules apply.
Pretty much. Like with stock, the partnership must be a QOZ business when the QOF acquires the interest, or be organized with that specific purpose. And just like with the stock, the partnership must qualify as a QOZ business for at least 90% of the time the QOF holds that interest. And that same U.S. territory nuance applies here too. If the partnership is organized in a U.S. territory, it has to conduct its QOZ business in that specific territory to qualify. So parallel rules for corporations and partnerships.
Okay, makes sense. Stock and partnership interest. What's the third category? This must be the actual physical stuff, right?
Exactly. The third category, and often the most visible one in terms of actual community development, is QOZ business property. This refers to tangible property, think real estate, buildings, machinery, equipment, that a QOF or a QOZ business acquires, either by purchase or by lease after 2017. And critically, it must be used in a trade or business within a QOZ. Now, there are different sets of requirements depending on whether the property is purchased outright or if it's leased.
Okay, let's start with purchase tangible property then. What are the key requirements there to make sure it qualifies and, helps meet that all-important 90% QOF standard?
Right. For purchase tangible property, there are two main tests, and these are really designed to drive real investment into these zones, not just passive holding. The first is that the use of the property in a QOZ must originate with the QOF, or the QOF must substantially improve the property. That substantially improved test, that's where a significant amount of capital expenditure often comes into play, genuinely driving economic activity.
How is substantial?
Good question. To satisfy this test, during any 30-month period beginning after the acquisition date, the additions to the basis of the property in the QF's hands must be more than the adjusted basis of the property at the beginning of that same 30-month period.
Okay, so double the basis in 30 months, essentially.
Essentially, yes. When we say adjusted basis, we're generally talking about the original cost of the property, maybe minus any depreciation taken. So this test really ensures new, meaningful investment is happening, not just, buying an old building and sitting on it.
Yeah.
The second test for purchase tangible property is that during substantially all of the QOF's holding period for the property, substantially all of the use of the property must be in a QOZ. It's kind of a mouthful, but it breaks down.
Okay, break it down.
To meet this, at least 70% of the property's actual use must be in a QOZ. And that needs to be true during at least 90% of the time the QF held the property. So it's a dual, substantially all requirement. One for the holding period and one for the actual use of the property itself.
70% use, 90% of the time. Got it.
Right. And it's also important to note another crucial flexibility here. Tangible property that is actively undergoing substantial improvement can be treated as QOZ business property for that 90% investment standard during that 30-month improvement period. The condition is that there has to be a reasonable expectation it will qualify once the improvements are actually completed.
Ah, that makes sense.
Yeah, this allows for those longer-term development projects to be actively in progress without accidentally jeopardizing the QOF status in the meantime. You don't want to penalize the fund for actually doing the work of development.
Absolutely. What if a QOF is purchasing, say, multiple buildings in a QOZ, maybe as part of a larger campus or development project? Do they all have to meet this substantial improvement test individually? That could be tough.
Not necessarily, and this is another really significant flexibility built in, especially for developers doing larger projects. If you purchase multiple buildings located in a QOZ, or even potentially in adjoining QOZs, you can actually treat them as a single property for the purposes of meeting those substantial improvement requirements.
Oh, interesting. How does that work?
This applies if all the eligible buildings are located entirely within, say, one parcel of land described in a single deed. Or maybe all the buildings are located entirely within the geographic borders of adjoining parcels of land described in separate deeds, and a few other conditions are met. Namely, each building has to be operated as one or more trades or businesses exclusively by the QOF, and the buildings need to share facilities or significant centralized business elements, like maybe shared parking or management, and they have to be operated in coordination with each other.
I see.
This provision is really vital for those larger, more integrated development projects. It allows them to qualify for the substantial improvement test on an aggregate basis, rather than having to meet that potentially difficult doubling of basis test on every single building individually. It really encourages comprehensive neighborhood revitalization instead of just piecemeal efforts.
That's a really good practical consideration, especially for big urban redevelopment type projects. Okay, so that covers purchased property. What about leased tangible property? How does that qualify as QOZ business property since the QOF isn't owning it outright?
Right, leased property is common too. For leased tangible property, there are also two main tests. First, at the time the lease was actually entered into, the lease terms must reflect common, arm's-length market pricing in the specific locale that includes the QOZ.
Yeah.
This arm's-length concept is crucial across tax law, really. It just means the transaction has to be conducted as if it were between totally unrelated parties acting in their own best interests. It prevents, artificial valuations designed to maybe circumvent the rules. It ensures fair market value transactions are taking place. Now, there is an interesting exception here. Leases with state governments, local governments, or Indian tribal governments are not subject to this market rate requirement. That offers some nice flexibility for public-private partnerships.
Okay, fair market terms. What's the second test for leases?
The second test is actually the same as it was for purchased property. During substantially all of the QOF's holding period for the property, or in this case, the lease period substantially all of the use of the property was in a QOZ.
Ah, the 70-90 rule again?
Exactly. At least 70% of the property's use must be in a QOZ during at least 90% of the time the QF actually leased the property. Same standard. Now, there are some additional requirements specifically for tangible property leased from a related person, like, say, leasing from another company owned by the same people. This is really important to prevent potential abuse and ensure genuine economic activity is happening.
Makes sense. What are those rules?
Well, the lessee, the QOF or QOZ business, must not make any prepayment for the lease that exceeds 12 months. So no massive upfront payments. And if the leased tangible personal property like equipment, not real estate, was used in the QOZ before the lease began, the lessee must actually purchase other QOZ business property with a value at least equal to the value of that leased personal property. And they have to do this before the earlier of the last day of the lease term, or 30 months after receiving the property under the lease.
Wow, okay, so they have to make an equivalent investment if they lease used stuff from a related party.
Exactly. These rules ensure that even related party transactions still contribute meaningfully to new development or investment within the QOZ. And one last point on property definitions. There's a specific rule for real property that actually straddles a QOZ boundary and a non-QOZ area. Think of a building where part is in the zone, part is out.
Yeah, that's what's happened sometimes.
It does. Such property can still be treated entirely as QOZ business property if it meets a few requirements. The portion within the QOZ must be used in your trade or business, and the portion outside the QOZ must also be used in your trade or business. Crucially, the portion within the QOZ must be considered substantial compared to the non-QOZ portion. How do they measure substantial? Either its square footage inside the zone must be greater than outside, or its unadjusted cost basis attributable to the inside portion must be greater than the outside portion.
Okay, so more than half in the zone, basically, my area or cost.
Essentially, yes. And they have to be adjoining, meaning they possess common boundaries, even if maybe a road or street runs between them. This allows for larger projects that might just happen to span a zone boundary to still potentially qualify for the benefits, which recognizes the practical realities of real estate development.
Okay, wow. So whether you're buying a brand new building or doing a major gut renovation on an existing one, or maybe just leasing space, or even dealing with these properties that straddle the zone lines, there are definitely clear pathways to qualify that property. But yeah, clearly with very specific hoops you have to jump through. It's definitely not just a simple matter of buy property located in a QOZ and you're automatically done.
Not at all.
There are precise rules, and they seem clearly designed to ensure genuine economic activity happens and to prevent purely passive investment from somehow claiming these pretty significant tax advantages. Okay, so we've established what qualifies as opportunity zone property. But remember, you said the QOF often invests in QOZ businesses, which then in turn hold that QOZ property. So what makes a business itself a QOZ business in the first place? This seems like the next critical layer, right? This is where the property rules and the operational rules really have to kick in together to drive that economic activity in the zones and provide the fundamental basis for the QOF's investment to even qualify.
Indeed, this is absolutely critical. For a trade or business to qualify as a qualified opportunity zone business, QOZ business, it has to satisfy a whole set of, frankly, pretty rigorous tests. These are designed to ensure it's genuinely contributing to the zone's economy. The first critical test is the tangible property rule. At least 70%, that number again, 70% of its owned or leased tangible property must actually be QOZ business property, meeting those definitions we just went through. This directly links back to the property rules, ensuring the business's physical assets, its operational footprint, are predominantly located and utilized within a QOZ.
Okay, 70% of its stuff has to be QOZ property. What else?
The second test is the gross income rule. At least 50% of the business's total gross income must come from the active conduct of a trade or business in a QOZ.
Active conduct.
Yes, active conduct. This is a really powerful rule. Prevents businesses from just having, say, a mailbox or a tiny office in a QOZ while generating almost all their income somewhere else entirely. It forces genuine income-generating operational activity to happen within the designated zone.
Makes sense. Test 3.
The third is the intangible property rule. A substantial part of its intangible property, think things like intellectual property, patents, trademarks, maybe valuable customer lists, must be used in the active conduct of such business within a QOZ. This ensures that the core operations and the real value drivers of the business are fundamentally tied to the zone, not just, sitting in some distant administrative office.
Okay. Tangible property, gross income, intangible property. What's next?
The fourth test is particularly important, especially for financial structuring and tax planning. It's the non-qualified financial property NQFP rule. Basically, less than 5%, just 5% of the average of the total unadjusted basis of the business's property can come from NQFP.
And QFP, what counts as that?
NQFP broadly includes passive-type assets, things like debt instruments, stock in other companies, partnership interests, options, futures contracts, stuff like that. This rule essentially prevents a QOZ business from being primarily just a passive investment vehicle itself. It ensures it's actively engaged in a real trade or business, not just holding financial assets.
Okay, less than 5% passive assets.
However, there is a crucial exclusion from NQFP, and this is huge. It does not include reasonable amounts of working capital held as cash equivalents, or those short-term debt instruments 18 months or less.
Ah, the working capital.
Yes. This is a absolutely vital tax-saving, or maybe tax benefit preserving, and flexibility provision. It allows a QOZ business to hold the liquid assets it needs for its day-to-day operational needs and for future development without failing that very strict 5% NQFT test.
That seems incredibly important. Okay, and the last test.
Finally, the fifth test involves prohibited businesses. The business simply cannot be certain types of operations. The list includes things like a private or commercial golf course, a country club, a massage parlor, hot tub facility, suntan facility, a racetrack, or any other gambling facility, or any store whose main business is selling alcoholic beverages for consumption off-premises, like a liquor store.
Okay, so some specific exclusions there.
Right. This clearly defines the types of businesses the QOZ incentives are not intended to support. It helps focus the benefits on activities considered more broadly beneficial for community development.
That NQFP rule, though, with the working capital exclusion, that sounds like a massive relief valve. I
Mhm.
mean, if a business genuinely needs cash on hand to grow or to fund the next phase of development, you definitely don't want that necessary cash to suddenly disqualify them from being a QOZ business. How does this working capital safe harbor really work in practice? Especially for those larger, maybe multi-phase projects you mentioned?
You're absolutely right to focus on this. This working capital safe harbor is genuinely one of the most significant flexibility and tax benefit preserving details within the entire QOZ framework. Precisely because it addresses the practical realities of how development actually happens over time. It allows a QOZ business to exclude those reasonable amounts of working capital from its NQFP calculation, providing that crucial operational breathing room, especially for projects that unfold over, say, several years. Now, for the safe harbor to apply, several pretty strict requirements must be met. It's not automatic.
Okay, what are the hoops?
First, the working capital must be designated in writing. You need a formal document stating it's for the development of a trade or business in a QOZ. This could include, when appropriate, the acquisition, construction, and that substantial improvement of tangible property within a QOZ. So it can't just be a handshake deal. You need a clear, documented plan outlining exactly how these funds are intended to be used.
Written plan, check.
Second, there must be a reasonable written schedule for the consumption of that working capital to achieve the designated goal. This isn't just some vague intention. It needs a timeline, demonstrating a real commitment to action and deployment of the funds.
Written schedule, check.
Third, the working capital generally must be consumed within 31 months of the business's receipt of the assets. Now, 31 months is a decent window for initial project phases.
Okay, 31 months.
But what's even more flexible and really key for bigger projects is that additional applications of this safe harbor are possible. This allows for a total period of no more than 62 months, provided each separate application meets all the regulatory requirements. This 62-month potential is absolutely key for those larger, multi-phase developments where a single 31-month period just wouldn't be enough time.
62 months. That's over 5 years. That's significant.
It is. Fourth requirement. The working capital must be actually used in a manner that is substantially consistent with that written plan and schedule we talked about. Consistency between the plan and the actual use is paramount for maintaining compliance and proving genuine intent.
Got to stick to the plan.
Fifth, if the consumption of the working capital assets gets delayed solely because you're waiting for government action on a completed application, think permits, zoning approvals, things like that, that kind of delay doesn't cause a failure of the safe harbor. This is a really practical recognition of bureaucratic realities, right? It ensures funds aren't penalized for administrative bottlenecks that are genuinely beyond their control.
That's good, yeah. Sensible.
And six, if the QOZ business happens to be located in a QOZ that's inside a federally declared disaster area, the business may receive up to an additional 24 months to consume its working capital assets, provided it meets some specific regulatory requirements. This shows an adaptability for truly unforeseen circumstances, acknowledging that development timelines can be seriously impacted by external events like hurricanes or floods.
Okay, so lots of rules, but also some built-in flexibility for real-world situations. Can you give an example of how that multi-phase thing might work?
Sure. So, to give you a real-world feel, imagine a QOF invests, say, $10 million cash into a QOZ business. And that business intends to develop a massive mixed-use real estate project, maybe combining commercial storefronts and residential apartments upstairs. Their master plan, let's say, spans 55 months. Perhaps they plan to build the commercial portion over the first 30 months and then tackle the residential component over a subsequent 25-month period. Now, even though that total timeline of 55 months clearly exceeds the initial 31-month safe harbor period, this business can still take advantage of the working capital safe harbor. As long as they have that meticulous written plan, maybe broken down into phases, documenting how the working capital will be consumed for each phase, and as long as it's actually spent according to that plan, this flexibility allows for multiple, potentially overlapping or sequential working capital safe harbors, adding up to that maximum potential of 62 months. This is just invaluable for those complex long-term projects that really aim to transform a community over several years.
Yeah, this working capital safe harbor is truly a big deal then. It really does give businesses the breathing room they absolutely need to actually develop and build in these zones without immediately failing the rules just because they're holding cash that's earmarked for future phases of a legitimate project. It seems clearly designed to encourage real long-term development, the kind that actually sticks around and makes a difference, which is exactly what these zones need, rather than just, quick, maybe superficial investments that don't last. It shows a really deep understanding of how development actually works on the ground. Okay, so you've hopefully grasped the key definitions, that crucial 90% rule, and what makes a QOZ business eligible in the first place. Now, let's finally talk about the practical side, the actual form you need to navigate to certify all this stuff. Form 8996. Who exactly has to file this form, and what's its overarching purpose in the grand scheme of keeping these tax benefits alive?
All right, Form 8996. This form is used exclusively by a corporation or a partnership that is organized and operated specifically as a Qualified Opportunity Fund, QOF. It's really critical to understand that the underlying QOZ businesses themselves do not file Form 8996, okay? This form is specifically for the investment vehicle, the fund itself, that is pooling capital for those QOZ investments.
Only the QOF files it. Got it.
Only the QOF, and the QOF has to file Form 8996 annually. It gets attached to one of several applicable tax returns just depending on its legal structure. For example, if the QOF is a corporation, it might file it with its Form 1120. If it's a partnership, it would likely file it with its Form 9065. Now, filing this form is fundamentally how the entity self-certifies as a QOF. By submitting Form 8996, the QOF is effectively attesting to the IRS, under penalties of perjury, that the property it uses to satisfy that 90% investment standard is, in fact, legitimate QOZ property. This includes implicitly verifying that any QOZ stock or QOZ partnership interests it holds are in an entity that genuinely qualifies as a QOZ business, meeting all those tests we just talked about.
So it's a self-certification.
It is. And that self-certification comes with a pretty serious caution. If it turns out that the underlying entities, the businesses the QOF invested in, don't actually satisfy all the QOZ business requirements, the QOF itself may be subject to penalties. And that, of course, jeopardizes those valuable investor benefits. The due date for Form 8996 is simply the same as the due date of the tax return it's filed with, including any extensions.
All right, so it's the QOF's annual declaration and proof of compliance. Let's get into the structure of the form itself now. We probably don't need to go literally line by line through every single box, but what are the main parts and what's the crucial information being conveyed in each section? Understanding the intent behind the questions seems like it would be a huge advantage for, managing compliance and maximizing those tax savings.
Absolutely. Understanding the why behind each part is key. We can cover the strategic intent of each major part. Let's start with Part 1, QOF certification. This section is completed every year, and its purpose is to formally certify that the corporation or partnership was organized specifically to operate as a QOF. It asks a really fundamental question right off the bat. Are you certifying that you are a qualified opportunity fund? If you answer yes here, well, you are self-certifying, and you absolutely must complete the rest of the form. This is your official declaration of intent to the IRS saying, yes, we're operating under these QOF rules.
Okay, the main declaration.
Right. Then another key question here is whether this is the first period you are certifying as a QOF. If it is your first time, you then have to specify the first month you chose to actually be a QOF. Now, this first month choice is really critical because it dictates exactly when your QOF's tax benefits truly begin, and it also sets the start date for when your testing periods for that 90% rule will be measured from going forward.
So timing matters there?
Timing matters a lot. For instance, maybe a new corporation is formed in January, but it only receives its very first qualifying investment, one where an investor makes a gain deferral election. Maybe that doesn't happen until May. That corporation actually has the flexibility to choose any month from January through May as its official certification date. Choosing May would allow that May investment to qualify. However, you cannot choose a month before your entity was actually legally formed. So if you formed in July, the earliest you could pick is July. This really highlights the importance of precise timing when you're bringing a QOF online and coordinating with investor contributions.
Okay, careful planning needed there. What else is in Part 1?
Finally, Part A also asks if the QOF made a disposition of QOZ property during the year, specifically one to which an investor's gain deferral election applies. If you check yes here, it means you've sold an asset that was part of the QOZ program, potentially triggering deferred gains that might now become taxable for your investors. If you check yes, you then must attach a detailed statement to your tax return providing specifics about the investors involved. This ensures the IRS has the information needed to track when those deferred gains might be coming due for taxation.
Okay, so Part A basically establishes your identity as a QOF for the year and signals any major events like first-time certification or dispositions. Now let's move to the really critical compliance check, the part where the IRS determines if the QOF actually met that crucial 90% investment standard. It seems like the real heart of the form, isn't it?
It absolutely is. Part 2, 90% investment standard calculation. This part is where the QOF has to demonstrate, with numbers, whether it met that vital 90% investment standard for the year. Before you even get to the numbers, though, you have to consistently choose one of two possible value determination methods for all your assets, and you have to stick with that choice throughout the entire tax year.
Two methods. What are they?
You can either use the applicable financial statement, AFS valuation method, which basically relies on the asset values reported on the QOF's applicable financial statement, assuming it's prepared according to U.S. GAAP and properly values leased assets. Or you can use the alternative valuation method.
And the alternative method.
The alternative valuation method generally uses the unadjusted cost basis for property the QOF purchased or constructed for fair market value. For other property the QOF owns, it uses the fair market value determined on the testing dates. And for property the QOF leases, it uses the present value of the lease payments, calculated using a specific discount rate found in the regulations. The key thing is you pick one method and apply it consistently for the whole year for accurate reporting.
Okay, pick a method, stick with it. Then the numbers.
Then the numbers. You provide two key sets of figures. First, you report the value of all your QOZ property and the value of your total assets as measured on the last day of the first 6-month period of your tax year. You divide the QOZ property by the total assets to get a percentage for that first test date. Second, you do the exact same calculation QOZ property value and total asset value, but this time using the values from the very last day of the QOF's tax year. This gives you a second percentage for the year-end test date. These two percentages are then averaged together to get your overall compliance percentage for the year.
Okay, average of the two test dates. What about that first year again?
Right. There's a special consideration for the very first year a QOF operates. If your chosen first month of certification, back in Part A day, means that your initial 6-month period hasn't actually ended by the time that first testing date rolls around, which is the end of the QOF's first 6 months, then the lines on the form for that first test date calculation will simply be left blank.
And no penalty for that.
And you won't be penalized for that initial short period. The whole purpose of these calculations in Part 2 is to explicitly show the IRS whether your average QOZ property percentage across the relevant testing periods was at least 0.9090%. If that average is less than 0.90, well, penalties may apply.
Okay, so those two measurements, or maybe just the year-end one in the first year, they feed directly into the penalty determination part. This is where the rubber really meets the road for the fund's compliance, right?
Precisely. That leads directly into Part 3, penalty determination. This part explicitly determines if your QOF is potentially subject to a penalty for failing that 90% test. It takes the percentages calculated in Part 2 from your two test dates, or just the one, if applicable in the first year, and calculates the simple average QOZ property percentage for the entire year. Then comes the crucial check. It's a simple yes or no question. Did the QOF meet the 90% investment standard? If your calculated average is 0.90 or greater, you check yes, breathe easy, and you're generally good on this front. And if it's less than 0.90, if it's less than 0.99, you must check no, clearly indicating a failure to meet the standard. And if you check no, you then must proceed directly to Part 4 to actually calculate the penalty amount. The IRS will then typically send you a notice regarding that penalty, which will include information on any potential reasonable cause, relief processes, and instructions on how to pay it. But importantly, even if you did meet the standard and checked yes in Part 3, you must still complete the subsequent parts of the form, Parts 5 and E6 and maybe 7. Those parts provide critical transparency to the IRS about your actual QOZ investments, regardless of whether you pass the 90% test.
Okay. So even if you pass, you still have to show your work, basically. And if you do fail and check no, how is that penalty actually calculated? What does that look like in Part 4?
All right, that's Part 4. Penalty calculation. You only complete this part if you check no back in Part 3, indicating you failed to meet the 90% standard for the year. This section is where you calculate the penalty amount, and it's figured out for each month during the year that the QOF didn't hold at least 90% of its assets in qualifying QOZ property. The form divides the tax year into 12 monthly columns. You apply the calculations based on the period you were actually certified as a QOF. For example, if your certification month in Part A is at April, then April would be considered month 1 for your penalty calculations, and you'd only fill out the columns for April through December, the months you operated as a QOF that year.
And the calculation itself.
The penalty for each month is determined by taking the shortfall, basically, the difference between the 90% target and your actual QOZ investment percentage for that month, or based on the test date percentages, and multiplying that shortfall amount by an underpayment interest rate, which the IRS determines and publishes quarterly. So it's essentially an interest charge on the amount by which you fell short of the compliance target, calculated month by month for the period of noncompliance.
Okay, a monthly penalty based on the shortfall. Now we're getting into the parts where you actually report the details of the QOZ property itself, stuff that directly feeds into those crucial 90% calculations back in Part 2. This is where the IRS gets a really detailed look at what the QOF is actually investing in, right?
Exactly. This is the supporting detail. Part V, QOZ, business property, directly owned or leased by the QOF. This part is used specifically to report any QOZ business property that the QOF itself directly owns or leases. Not property held by underlying QOZ businesses, but property held directly by the fund. Here, you'll list the unique 11-digit QOZ number for each specific zone where the QOF directly owns or leases qualifying property. These are the official zone designations provided by the IRS. Then, for both test dates, the last day of the first 6-month period and the last day of the tax year, you'll report the total value of all the directly owned QOZ property, and separately, the total value of all the directly leased QOZ property located in each specified QOZ. This gives the IRS a clear picture of the assets the QOF directly controls within the designated zones. There's also a little note here regarding mobile tangible property, think construction equipment that moves around that might be used in multiple QOZs. It directs you to the instructions for Part 6 for more detailed guidance on how to properly allocate its value, which we'll get to.
Okay, so Part 5 is for the QOF's direct holdings. And Part 6 must be where things get even more intricate, because that deals with the investments the QOF makes in the underlying businesses, not just the property it owns directly. For many QOFs, this is probably the most common way they invest, wouldn't you say?
You're absolutely right. Investing in QOZ stock or partnership interests is a very common structure. So Part 6, investment in QOZ stock or partnership interest is absolutely crucial. This section is where you report your investments in those QOZ stocks or partnership interests. And the really key thing here is that you must apportion the values of those investments based on where the tangible property of the underlying QOZ business is actually located. This provides really granular detail to the IRS about where the economic activity supported by your investment is happening.
Apportionment. How does that work? And what about that working capital?
Good questions. First, a key point here regarding working capital property. If an underlying QOZ business has working capital that qualifies for that safe harbor we discussed, you specifically allocate the value of that working capital to the particular QOZ that's stated in the business's written designation for the development project. This ensures that even unspent but properly designated working capital gets attributed to a specific QOZ for reporting purposes on the QOF's Form 8996.
Okay, working capital gets assigned to its plan zone.
Right. Now, for each QOZ business the QOF has invested in, you'll first list its Employer Identification Number, EIN. Then, for both test dates, the first 6-month period and the tax year end, you'll report the investment value of your QOZ stock or partnership interest in that business. But here's the apportionment part. This value needs to be broken down and reported according to the share of tangible property that the underlying QOZ business holds in each specific QOZ.
Can you give an example of that?
Sure. Let's say your QOF, call it QFA, has a $1 million investment interest in QOZ Business B. Now, suppose QOZ Business B owns tangible property worth $2 million located entirely within QOZ X, another $1 million worth of property entirely within QOZ Y, and maybe $1 million worth of property located completely outside of any QOZ.
Okay.
For reporting on Form 8996 Part 6, QOFA would need to apportion its $1 million investment value. Since 50% of Business B's tangible property, 2 MRs out of $4 total, is in QOZ X, QOFA reports $500,000, 50% of its $1 investment associated with QOZ X. Since 25% of the property owned below $4 is in QOZY, QOFA reports $250,000 associated with QOZY. And since 25% is outside any QOZ, QOFA would report the remaining $250,000 associated with non-QOZ locations, using a special code 999999999 for the QOZ number.
Wow, okay, so the QOF's investment value gets sliced up based on where the business's assets are? That's detailed.
It is. This precise apportionment ensures the QOF's investment is correctly reflected in its own 90% test based on the actual geographic location of the underlying business's assets and activities.
Part 6 also specifically addresses how to handle that mobile tangible property we mentioned earlier, property that might be used in multiple QOZs or even outside of QOZs. If such property otherwise qualifies as QOZ business property, its full value is generally assigned to the single QOZ where it's primarily used, meaning the QOZ that receives the highest percentage of its use during the period. There's even a specific safe harbor for a limited amount of mobile tangible property. Basically, up to 20% of a QOZ business's tangible property can consist of mobile property that might be used outside a QOZ, but it can still satisfy the 70% QOZ use test if certain conditions are met. These include things like the business having an office in a QOZ, having employees who regularly use the property based out of that office, the property being substantially used by those employees in the QOZ, and the property not being exclusively used outside the QOZ for more than 14 consecutive days.
Okay, practical rules for things like construction equipment or delivery trucks.
Exactly. It's a practical recognition for businesses that might have assets that naturally move in and out of the zone, but still primarily serve the development or operations within that zone. Lastly, for each QOZ business listed in Part 6, you also need to report the gross value of the tangible property that is owned by that QOZ business, and separately, the gross value leased by that QOZ business, broken down by each specific QOZ where the property is located. You report this for both test dates as well. Importantly, this is the gross value of the underlying business's property, not adjusted for the QOF percentage ownership share. This gives the IRS a clear picture of the scale of the underlying assets in each zone.
Okay, so investment value apportioned plus gross asset values of the underlying business. What happens with all these numbers from Parts V and 6?
All these detailed figures from Part V, Direct Holdings, and Part 6, Investments in Businesses, then feed into crucial summary lines right at the end of Part 6. These summary totals are the numbers that directly populate lines 7 and 10 back in Part 2, the lines reporting the QOF's total QOZ property value for the 90% investment standard calculation. It's all meticulously interconnected. And you also have to check a box on Part 6 indicating which valuation method, AFS or alternative, you used.
Okay, it all flows back to Part 2. And what if you have a massive portfolio, like investments in QOZ businesses that operate in dozens of different QOZs? Do you just keep adding pages?
That's exactly where the final part comes in. Part 7. Addition lines for Part 6. If you simply need more lines to report all your investments in QOZ businesses, especially those that might have tangible properties spread across many different QOZs beyond the space provided in Part 6, you just continue on to Part 7. The logic and the instructions for all the columns in Part 7 are identical to those in Part 6. You list the additional QOZ locations, apportion the investment values, report the gross asset values, and so on. You then total the relevant investment values from Part 7, and these totals are carried back to summary lines within Part 6 itself, ensuring that absolutely all of your qualifying investments are accounted for in the final calculation.
Okay. As you can definitely see just listening to this, the form requires really meticulous detail, and that level of detail directly reflects the strict criteria needed to maintain these very valuable tax benefits. It really underscores that it's all about accountability, right? Ensuring the investments are genuinely flowing into the designated zones as intended, and that the significant tax advantages are truly earned through diligent compliance and real measurable economic activity.
Exactly. And if we try and connect all this back to the bigger picture, Form 8996, it really isn't just about regulatory compliance or filling out boxes. It's effectively the operational guidebook for a very specific type of investment vehicle. One that was designed, first and foremost, to spur economic development in areas identified as needing it most, while simultaneously offering investors potentially significant tax deferral and even reduction opportunities on their capital gains. So truly understanding the specific rules, what constitutes QOZ property, what defines a QOZ business, and especially that crucial 90% investment standard, along with its really important built-in flexibilities like that working capital safe harbor and the reinvestment periods, these are the true levers for maximizing those tax savings and ensuring the program worked as intended. It's definitely a sophisticated system, and the form, well, it demands that same level of sophistication in its completion and in the ongoing management of the fund.
You've now had, hopefully, a pretty comprehensive deep dive into the inner workings of qualified opportunity funds and the form that governs them. Form 8996, you're hopefully no longer just looking at what seems like a dense, confusing tax form. Maybe you're seeing it more as a strategic financial instrument and understanding how its very precise rules allow for significant tax advantages, but advantages that are intrinsically tied to driving community revitalization. So thinking about that connection, given the specificity and the often long-term nature of these QOZ investments, what other, perhaps lesser-known tax advantage investment vehicles might exist out there? And how could understanding their precise rules, much like we've done with QOFs today, potentially unlock similar opportunities for your own financial strategy, maybe in areas you hadn't even considered before? Something to think about. Thank you for joining us for this deep dive. We'll see you next time.